Hello, good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. So very good morning. Next week will be the last week of December and time passed indeed pretty fast. So I hope that so far you all have a great 2023. So today will be Wednesday 21st, pardon me, today will be Thursday 21st of December. So before we start our daily dose of market insights, let's take a look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses could actually exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, we will kickstart with a brief overview of key events that took shape yesterday in terms of economic data, and as well as possible, let's say, anything that's related to the markets like Federal Reserve officials speaking. So let us take a recap of what key data yesterday was. As we know that right now we're coming approach to the end of the year where market activities tend to tone down. Also, it moves in line with the release of data as well. So yesterday was only one key data I want to highlight over here will be the UK inflation data. So the UK inflation data, as you could see on my screen at this point in time, that is flashing. So that was Wednesday. So the core inflation rate actually went down below expectation, which is year-on-year basis for the month of November, 5.1% year-on-year versus expectation of 5.6%, way below it, and also way below the previous month of October at 5.7%. So if you look at the trend of the core inflation rate in UK, it's been dipping down lower and lower since at the start of the second half of this year, which is July 6.9%. So it's been dipping down pretty deceleration in terms of inflation growth has been pretty much drastic. So yesterday's 5.1% year on year is actually the lowest level since January 2022. All right, so that's close to about a 1.5 year of low, coming to 2 years low, I would say. So if you look at the longer term trend, you could see that it starts to decelerate. So what it actually implies to the market right now is that overall inflation data globally in terms of growth trajectory is actually inching down on the deceleration mode. All right, still got some more way to hit the 2% level mark, but it's actually inching down rather than reversing upward. So that is actually a plus point in terms of inflation growth perspective. So but however, in a longer picture, we also got to understand that these data are actually more lagging in nature. So we got to pay close attention to commodity prices that are actually leading indicator of future inflationary growth, especially oil price, because oil price right now has starts to inch up slightly higher, around the West Texas crude oil is about $70 per barrel. So later I'll share with you on the short-term technical outlook on West Texas oil. So if oil price continue to actually inch higher in the, let's say, the first half of next year, up to spike up back to $90 per barrel, then inflation pressure could actually come back into the picture again. But for now, at least in the short term, lower growth deceleration in terms of lagging inflationary data globally translate to lower longer term government bond yields. That's one thing. That means also will lead to translate to lower US 10-year treasury yield, that is the global benchmark, which will lead to lower potential US dollar. Then thereafter potentially fit on to this ongoing risk on behavior that was seen in the late October this year, and potentially we could start to see a further substantial movement in terms of the benchmark US stock indices globally, as well as spreading to the rest of the world, with the exception case of China and Hong Kong. Why? Because China and Hong Kong benchmark indices is being impacted by structural weakness in China economy, which is primarily driven by the persistent weakness in the property sector, that so far the China central top policymakers to not, I would say that not, maybe I don't like to, not in favor of massive stimulus, we call it measures to elevate this persistent weakness in the property market in China. They rather rely on targeted measure. Okay, so that actually why I explained that persistent underperformance of the Hong Kong and benchmark China stock market indices against the rest of the world. Okay, so this is the flow that the chain effect that I hope to share with you all. So another important news that I share with you all is this particular Fed official. So Fed Harker actually spoke yesterday. Okay, so what he did mention over here is that this he sounded not as hawkish as the previous Fed official Bostic. Yeah, he do agree that rates should move down, but not immediately. So it seems to apply that it should potentially come in the second half of next year rather than March. So, but despite his this current dose of what you call it current dose of Federal Reserve officials speaking, quite Fed speak so far, market are still earing towards the dovish expectation of the story. If you look at the CME FedWatch 2 at this point in time, so this is you can actually take a look over here. So if you click on probabilities, it gives you a total probability based on the meeting dates in 2024. Okay, so if you look at the first interest rate cut with a high probability is 83%. That is actually much higher last week. Last year was around 60+%. So right now, market is actually pricing in 83% chance of the first cut to come as early as March 2024 FOMC, ignoring the fact that some of the Federal Reserve officials are not as dovish as market expectations. So it seems to the market right now is actually trying to place a bet, indicating to this federal official, indicating to this rather, we call it not so dovish Fed speak up from the Federal Reserve officials saying that, hey, you guys got to cut earlier or else the US economy will start to slip into a hard landing or a recessionary like scenario. Okay, so there's kind of a challenge over here. So as we approach much closer towards March, March 20th over here, I do expect some volatility being spilled into the market at that point in time. So I will cover much more, especially when it comes closer during the daily dose of market insights. Okay, so these are the key economic data and highlights that we share. So now let's move on to market movement yesterday. So what's interesting over here is that the benchmark US stock indices actually rose at the start of the session, which the Nasdaq 100 and the Nasdaq 100 as well as the Dow Jones Industrial Average. In our platform, we call it the US Wall Street 30, almost hit our short-term resistance level that we highlighted in our daily dose of market insight yesterday. So have a quick recap. Yesterday, we do have a bullish bias. So price action indeed actually moved up towards our expectation at the start of the session, means during the first half of the US session before reversing down. So it actually ended. So we'll talk about the intraday movement. So the intraday movement, the Dow Jones Industrial Average actually went as high as 0.9%, followed by the Russell 2000. Then the Nasdaq and the S&P rose as much as 0.2% before giving up all its gains in the second half of the session. So during the second half of the session, what we could see over here is that all of them actually ended in the red. S&P negative 1.47%, Nasdaq negative 1.53%, the Dow Jones negative 1.27%, the Russell, the worst performing, negative 1.9%. So if you look at the price section across the board, starting with the S&P 500 first, this is the daily chart, the daily candle. So you look at the daily candle over here, there's signs of what I call bullish exhaustion that's being depicted. Okay, so initially it was a rally, that's little tail, but throughout the session it formed a black daily candle marabuzu. Okay, and this length of the black candle is the longest, where the medium-term uptrend kickstarted on the low of 27th of October. So indicating to us right now over here is that there is a high probability that the US stock market, that means using the S&P 500 as a proxy over here, is in the midst to at least retrace this medium-term uptrend that is in place since 27 October towards the 20-day moving average that I highlighted over here in red line. So that's around 4,620, at least in the short term. So what we could see over here is in terms of technical analysis speak, we are now in the process of a mean reversion decline or a counter trend decline or setback we in a medium-term uptrend in the US stock market. So across the board, we start to see this formation of this bearish daily candle, very similarly on the Dow Jones Industrial Average as well, that managed to hit fresh all-time high first last week. And the one that hit prior to yesterday was the Nasdaq 100, also shaping this long bearish Marabuzu candlestick. Similarly on the Russell 2000 as well. All right, at this point in time. So what we could see over here is that yesterday movement during the second half of the session was not driven by any key economic event. Okay, some could actually argue that it's due to that Red Sea geopolitical conflict, where actually there's this we call it Iran-backed rebels that is kind of putting a disruption in the Red Sea, where you see transportation of oil tanker. That's actually one of the reasons that causes the oil price to actually rally at the start of this week. And yesterday reaction was that US and some of its allies might do a counter attack to these Iran-backed rivals. So all in all, right, it seems to me that geopolitical over here. I think mic test 1 2 3. I hope that you guys can hear me, because there seems to be a disruption ongoing. Okay, let me test again. I think there's a disruption. Sorry about that. Okay, it seems to me that there's a disruption. So hopefully my voice is still clear. So far so good. Yeah. Okay, I think it's back. My mic is back. Yeah, good. Okay, where was I early on? Yeah. So yes, we start to see this geopolitical war premium coming back into the picture. But yesterday's sell-off in the later part of session didn't react in line with this war premium news. Okay, because this war premium news flow was actually took shape yesterday earlier, but market going to push up yesterday and even at the start of yesterday US session. So yesterday's selling is more likely related to technically factors with profit taking, where we start to see hourly RSI. Later I'll show you the hourly RSI. So when the price action of the intraday price action of the Nasdaq and the Wall Street do higher high, but however the RSI starts to flash a bearish divergence at the overbought level. So that actually explains a bit of fear in terms of that technical elements. So it kind of cascade a feedback loop back into the negative, we call it negative performance of the US stock market or the benchmark indices in the later half of the session yesterday. But this does not actually starts to actually filter to in the 10-year treasury yield. So if you look at the 10-year treasury yield at this point in time, it's still rather weak. Okay, so if you look at the US 10-year treasury yield, it continued to actually plummet much lower yesterday. Okay, and broke below last Thursday low. Okay, this is the US 10-year treasury yield at this point in time. So yes, it's oversold on the daily basis, but there's no signs of a bullish divergence yet, as the RSI going to shape lower low in line with the price action. So there is no clear what I call short to medium term downtrend, bearish trend exhaustion on the US 10-year treasury yield. So there's no spike up in the US 10-year treasury yesterday. So that also could actually imply that the US benchmark stock indices, what we are seeing right now is more of a mean reversion kind of decline or a counter trend decline, rather than a start of a new, we call it medium-term bearish reversal or medium-term downtrend in place. Okay, so then you look at the US dollar. So the US dollar index also still remains below the 200-day moving average. So yesterday price action was, since last Thursday, is more like a pennant, a bearish pennant. So a bearish pennant is like a little mini symmetrical triangle, which is more like a pause rather than a major trend, a medium-term trend, upside trend reversal to the upside instead. So the dollar itself also does not show any signs of a ongoing medium-term downtrend, doesn't show any signs of an exhaustion in the dollar as well. Okay, so I will view that yesterday sell-off in the benchmark US stock indices is more related to individual, we call it a related factor, that means individual technical factor, rather than a supported by inter-market analytical correlation using the US dollar and the 10-year technical elements as this, we call it a correlation, okay? Because if we will start to see a more substantial dollar weakness, not more substantial US benchmark weakness, that means indicate to us that right now we are potentially at the start of a new medium-term downtrend. The US dollar should show signs of a bullish reversal, followed by that 10-year US Treasury yield as well, signs of a bullish reversal. But at this moment, there is no signs that's been inherent in them, like I shared with you all earlier on. Okay, so that is the story of the market movement yesterday. I hope that I could dissect now in a much clearer point of view, looking at the macro picture together with technical elements to formulate a view. Okay, now back to the story. So back to our daily dose of market insight. We'll be covering the short-term technical outlook. Okay, so the short-term technical outlook right now over here will be, let us start with the major FX pair first. Okay, so yesterday we know that the FX market, the sterling dollar was the, okay, so it's a 5-day rolling performance. So the sterling was the weakest against the dollar yesterday. So this is based on the 5-day rolling. So using dollar as a base currency, that means dollar versus sterling to make it more uniform. So the dollar actually rose against the sterling yesterday. So based on its 5-day performance, we could see this was the uptick yesterday at +1%. At this moment, it's +1.06% on the dollar versus the sterling. So why the dollar is the strongest performer against the sterling yesterday was due to the fact that of that weaker than expected inflation number. But however, the sterling still remains on support against the dollar. Later, I flash the short-term technical outlook for you. And if you recall, dollar yen, despite the earlier spike up of that at the start of Tuesday, where market was not so in favor of BOJ, lack of reluctance to give any hint of the imminent, we call it short-term negative interest rate removal. It was a spike up, but those who actually join our daily dose of market insight, we do mention that this spike up is more like a noise within a short-term downtrend that is still inherent in the dollar yen, which it turns out as expected. What we could see over here is that the dollar continued to plummet, and right now almost removing the earlier spike on that was seen on Tuesday itself. Okay, so then the rest of the currency pair continue to trade more like sideways, with dollar strength being muted. All right, so now let's start with the sterling dollar first, since that was the highlight yesterday. So on the sterling dollar, what we could see right now is that the price action, yes, it tumbled yesterday, means the sterling versus the dollar right now. So that's how the convention has been traded. So it actually finds support at our short-term pivotal level, pivotal support that we highlighted, 126.10, also confluence with this rising upward sloping 20-day moving average. So in terms of technical analysis chart pattern, that means from the high of, okay, this is an hourly chart, from the high of 15th of December all the way to the current price action, potentially it seems to be trading in a minor symmetrical triangle configuration, okay, which is pretty much I would say that sensible. Why? Because right now we are heading towards the year end, where liquidity starts to dry up in almost all the various asset classes. These people are less reluctant to establish new position, and most of the we call it major players in the FX market is more or less close their books in terms of risk taker like hedge funds, and as well as the order flow banks. That's all right. So that could actually explain this potential ongoing sideways movement that could be persistent throughout the remaining part of December this year, okay, which is up to next week. Yeah, so with that, right, we still use 1.2610 as my short-term pivotal support level for now. So upper boundary, which is the resistance, will be at the upper limit of this ongoing potential minor symmetrical triangle, with the upper limit at 127.30. So 127.30, if you do a Fibo retracement from the high of 15th of December all the way down to yesterday's low, it also confluence with 61.8% Fibo retracement as well. Okay, so for me, yes, we do have a still stick to the bullish bias, but more within this potential symmetrical triangle range configuration, with the upper limit at 127.30.
Okay, however, a breakdown below 126.10, then this could converge down into a more extension of a minor corrective decline to test 125.45 and 125 figure level. That's the next support level, which is also confluence with the 200-day moving average. Okay, sterling dollar has been done for now. Euro dollar next. So euro dollar next also going to trade in a sideways configuration as well, holding above yesterday's near-term support at 1.0930. 1.0930. So I do not want to use 1.0930 as my key short-term pivotal support for today because that's too tight. And also this does not have enough elements that confluence at 1.2930 because there's only one graphical support level over here. But I need to have at least two elements to make it two different elements that pointing to the similar level to indicate that this is indeed a pivotal support, which is 1.0890. Why? Because graphical support followed by mathematical support, which is the 20-day moving average. Okay, so still no change, 1.0890 as my key short-term pivotal support level to maintain this short-term bullish bias, at least push up to the top of this minor range resistance at 110.10 for now. However, a breakdown below 1.0890 potentially sees the extension of this minor corrective decline towards 1.0820, which confluence with the 200-day moving average as well. All right, so with that, let's move to the other Asia Pacific major pair, which is the dollar yen and the Aussie dollar. So before we that, let me expand my screen first so that you guys can see much clearer. So let us start with the dollar yen. Okay, so dollar yen, no change. 145.05 is indeed that pivotal resistance where that bearish reaction took shape, exposed BOJ. So this is where potentially we could start to see still maintain that bearish outlook on the dollar yen, heading down towards the first support to watch for will be 142.30. Graphical support also very close to the 200-day moving average, slightly below it. A break below 142.30 exposes the last Thursday's swing low area, minus swing low area at 140.95. All right, so maintaining that short-term bearish outlook. However, an hourly close and a clearance above 145.05 will start to see the extension of this corrective rebound towards the next resistance level at 146.70. Okay, so that's the outlook for the dollar yen, still maintaining that short-term bearish outlook below 145.05 short-term pivotal resistance. Then now, what's next for the Aussie dollar? So Aussie dollar, we flip to a bearish bias still for those who are actually joining us since the start of this week. Okay, 67.90 price action did react very close to this level, came down, hit the first support level before bouncing off again. So what we could see over here, why it bounced, because the RSI is almost hit the oversold level. So right now it's still trading below this descending trend line resistance in parallel around the 57 level mark. So it's something roughly around at this zone over here in terms of graphically. Okay, at 67.60. Okay, 67.60 is this near-term resistance to watch on the Aussie dollar, but I don't want to put it so tight over here, so still use 67.90 as my short-term pivotal resistance. A breakdown below 67.20 potentially exposes the next support at 66.70, which is all confluence pretty much quickly with the rising 20-day moving average as well in a couple of days. Maybe one more day time, it should actually reach this level. All right, so all in all, maintaining that short-term bearish bias on the Aussie dollar. However, if only a clearance above 67.90 will invalidate this short-term bearish bias view. So this bearish view is more like a minor counter trend decline or setback within a medium-term uptrend that is still in place. Or I would say within a short and medium-term uptrend that is still in place. Why? Because price action is trading above the 20-day and the 50-day moving average. Okay. However, a pierce up above 67.90 will invalidate this minor counter trend, we call it scenario, to kickstart another leg of impulsive up move to test the next resistance at 68.40/68.70 in the first step. Okay, so that's for the Aussie dollar. So that sums up the view for the FX pair. So all the FX pairs, what we could see over here is that we are still in dollar weakness in the short term, except for Australia dollar, where potentially we could see the Aussie dollar staging that minor corrective rebound, a minor corrective decline against the dollar in the short term. All right. Now, major stock indices. So let's start with the US market first. So for the US market, let's start with the Nasdaq 100. So those we call the Nasdaq 100. Yesterday we have the resistance level to watch will be 1695/16900. So price actually almost hit that level, give or take 16,900, 50 ticks away from 16,950 before plunging down in the later part of session where it broke below this ascending channel support, minor ascending channel support that is in place since 7th of December. So with that, before it staged this high over here, while it's staging this high, the price action on the hourly RSI start to shape that bearish divergence. All right, so that actually give rise to that sell-off that was seen in the later half of the US session after this divergence is being formed over here. So it's more like a technical driven, we call it factor as well, and most likely also due to the upcoming holiday season break, where traders do not want to establish very aggressive net long position, given the fact that we start to see last week 7 weekly consecutive up move. Yeah. Okay. Now with that break, what we could see over here is potentially the Nasdaq 100 right now is in the midst of a short-term counter trend decline scenario towards the next support level at 16,430 in the first step. So with that, I'll be using this short-term pivotal resistance 16,800 as my short-term pivotal resistance to actually advocate or kind of support this short-term outlook, bearish outlook, which is the minor counter trend scenario situation towards the next support at 16,430. Only an hourly close above 16,800 will invalidate this minor counter trend decline scenario to revive this bullish impulsive up move to retest 16,950/16,990 in the first step. That's for the Nasdaq 100. So flipping to a bearish bias, looking out for this start kind of minor short-term counter trend decline scenario to unfold on the Nasdaq 100 below 16,800 short-term pivotal resistance. Dow Jones Industrial Average. So Dow Jones Industrial Average, which is the Wall Street 30. So yesterday it pierced up. So this pierce up, after that pierce up, almost hit our resistance, which has 37,800. So yesterday it printed a high of 37,704, about 100 pips away or 100 ticks away. So after hitting that high, the RSI also shaped that bearish divergence as well. So that actually kind of give rise to that sell-off that was seen in the second half of the US session yesterday. So with that, I'll be using 37,540 short-term pivotal resistance to flip to a short-term bearish bias on the US Wall Street 30, potentially seeing this short-term or minor counter trend decline unfolding towards the next support level at 36,810, which confluence with the minor ascending channel support that is in place since 10th of November 2022 low. Only a clearance with an hourly close above 37,540 will invalidate this minor counter trend decline scenario to reinforce that bullish tone back again on the US Wall Street 30. In first step, to see the next resistance coming in at 37,800. All right, so flipping to a short-term bearish bias where potentially the US Wall Street 30 could be unfolding a short-term minor counter trend decline scenario right now below 37,540 short-term pivotal resistance. European currency, the German DAX. So the German DAX managed to bounce off our short-term pivotal support that we had yesterday at 16,650, but it failed to actually break above the previous high on last Friday at 16,900 level. So with that, the price action also kind of reacted off this previous ascending channel support level that is from the low of 27th of October. So indicate to us that this German 30 could also be in the midst of higher odds, in the midst of shaping that minor counter trend decline scenario, very similar to the one that I've shared with you all in the US benchmark stock indices as well. So with that, I'll be using yesterday's high as my short-term pivotal resistance to flip into a short-term bearish bias on the German 30 index, potentially where we could start to see the unfolding of this short-term minor counter trend decline with a breakdown below 16,650, reinforce this decline potentially to expose the next support level at 16,440. All right, so only a clearance with hourly close above 16,840, pardon me, 16,840 will invalidate this potential minor counter trend decline scenario to reinforce or that bullish tone towards 16,970, then thereafter followed by the next resistance with a higher high at 17,100. So i.e. flipping to a short-term bearish bias on the German 30 below 16,840, potentially seeing this short-term potential counter trend decline scenario to unfold as well on the German 30. The one that is surprisingly strong, do not forget, the Hong Kong 33 has been kind of moving in inverse relationship with the rest of the world. It actually shaped a rebound right above that 16,330 short-term pivotal support that we have. We highlighted yesterday, so still no change, still maintaining that 16,330 short-term pivotal support on the Hong Kong 33. First resistance to look out for will be at 16,890. So the Hong Kong 33 is still in the midst of doing this counter trend rebound within its medium-term downtrend that is still intact. Why? Because it's still trading below the 50-day moving average. Only a breakdown below 16,330 invalidates this short-term counter trend rebound scenario to see another choppy decline movement to retest the major resistance, major support zone at 16,100/15,890. Okay, so still maintaining that short-term counter trend rebound scenario on the Hong Kong 33 index, as long as 16,330 short-term pivotal support holds for now. Okay, so now very quickly on the commodity market. So commodity market, let's start with spot gold first. So spot gold /XAU/USD still continue to trade within above our short-term pivotal adjusted support level at 2015, which also correspond with this rising 20-day moving average. So still no change, still looking at 2015 level short-term pivotal support to maintain this bullish outlook view. But however, price action got to break above this minor range resistance that is in place since last Thursday at 2047 to potentially gain more traction towards the next intermediate resistance at 2067/2075. So that's XAU/USD. Only an hourly close below 2015 will invalidate this short-term bullish outlook on the spot gold. Then potentially we may start to see a unfolding of a minor counter trend, minor corrective pullback to test the 50-day moving average, which is confluencing at the graphical support level at 1997. Oil price, WTI. So WTI West Texas crude going to inch higher, and price action right now is holding above the 20-day moving average. So still no change. I don't want to cut it so tightly at 72.40. So 72.40 will be like a near-term support level, which corresponds very closely with the 20-day moving average. So still using 70.90 as my short-term pivotal support. So as long as this short-term pivotal support level holds, potentially West Texas Oil could see an extension of this potential counter trend rebound that is still in place since the low of 13th of December towards the next resistance at 78.40, which is pretty key. Why? Because 78.40 confluence with the 50-day moving average as well as the 200-day moving average also acting as a resistance at 78.40. Only an hourly close below 70.90 will invalidate this extension of this minor counter trend rebound scenario to kickstart a kind of another choppy decline movement towards the medium-term support level at 67.55/67 figure level over here. All right, so still maintain that short-term bullish outlook in this potential extension minor counter trend rebound scenario that is unfolding for West Texas Oil, as long as managed to hold above the 70.90 short-term pivotal support level. Okay, so that's pretty much sum up for the short-term technical outlook. So before we go over here is that I'm going to share with you the economic calendar. So economic calendar for today is rather quiet for Thursday. So key data that we have over here is okay, this is GDP growth rate in US, but that is the finalized one. So over the months we have some preliminary figure. So 9:30 p.m., but I do not see this as a major moving event because this is kind of a lagging indicator. What we have over here is pretty much quiet, except that at 11 p.m., pardon me, we do have a conference board leading economic index month-on-month that is coming out at 11 p.m. Singapore time. That's for the US conference board's leading economic indicator index. So that's the only key US data to look out for today. All right, so with that, that pretty much sum up for today's daily dose of market insight. So I do hope that you guys have a great day ahead, and we shall speak again tomorrow. Thank you.